If you've received equity compensation from a startup or a fast-growing company, there's a hidden tax decision that could cost you tens or even hundreds of thousands of dollars if you get it wrong. It's called the 83B election. Most people either don't know it exists, don't understand how it works, or find out about it after it's already too late. In this video, I'm going to break down what an 83B election actually is, how it works with incentive stock options and a startup equity. By the end, you'll understand why this is one of the most important tax decisions people with equity compensation ever make, and how to think about it the right way. To really understand why this matters, we need to start with the tax problem equity compensation creates in the first place. When a company gives you equity, the IRS doesn't look at it as ownership first. They look at it as income. And the core question the IRS cares about is very simple. When does this equity have value that should be taxed? By default, the IRS taxes equity when it vests based on its fair market value at that time. That sounds reasonable on the surface, but in the startup world, it creates a huge problem. Imagine you join a startup early. The company isn't worth much yet. You're granted equity at a very low valuation. Maybe the shares are worth a penny each, or even less. At that point, the equity feels almost meaningless. It's just upside. But over time, the company grows, it raised money, the valuation increases. Suddenly, those same shares felt worthless, now have a real value attached to them. Now imagine those shares vest over 4 years. Each time a portion of them vest, the IRS treats the value of those shares at that moment as taxable income to you. So if your shares end up being worth $5 each when they vest, and you have 100,000 shares, the IRS can treat that as $500,000 of income over time. And here's the part that surprises people. You owe taxes on that income even if you haven't sold a single share and haven't received any cash. That's how people end up with massive tax bills on paper gains, and that's why equity compensation can feel amazing on the upside, but terrifying when tax season comes around. The 83B election exists specifically to change when that tax happens. An 83B election is a form you file with the IRS that says you want to be taxed on your equity now instead of later. You're choosing to recognize income at the time you receive the shares rather than when they vest. And the reason people do this is because the value of the shares is often very low when you first receive them. By electing to be taxed early, you're locking in that low valuation for tax purposes. Once you file an 83B election, future appreciation is no longer taxed as ordinary income. Instead, it's generally taxed as capital gains when you eventually sell the shares. That difference between ordinary income tax rates and long-term capital gains rates is often enormous. But before we go any further, we need to clear up a huge misconception around incentive stock options, because this is where a lot of people get confused. Simply receiving incentive stock options does not mean you can or should file an 83B election. You cannot file an 83B election at the time ISOs are granted. At the grant stage, you don't own shares, you own options, and options by themselves are not eligible for an 83B election. Where the 83B election comes into play is when you early exercise your options. Many startups allow early exercise, which means you can exercise your options before they vest. When you do that, you're converting options into actual shares. Those shares are still subject to vesting, but legally, you now own them. And once you own shares that are subject to vesting, the 83B election becomes available. Another common situation where 83B elections apply is restricted stock. If you receive restricted stock directly instead of options, the 83B election is usually available immediately. So, if you've early exercised options or received restricted stock, this decision is very relevant to you. Let's walk through a concrete example because this is where the power of an 83B election really becomes clear. Imagine you early exercise 100,000 shares at 1 cent per share. You pay $1,000 to exercise, and at that moment, the fair market value is also 1 cent per share. If you do not file an 83B election, the IRS will tax you as those shares vest. If the company grows and those shares are worth $5 each when they vest, you could be taxed on $500,000 of income over time. Depending on your tax bracket and state taxes, That could easily result in a tax bill of $150,000 or more. And remember, that tax bill is due whether or not you sell the shares. If you do file an 83B election, the IRS taxes you immediately on the value at the time of exercise. In this case, that's $1,000 of income. The tax on that might be a few $100s. From that point forward, all future growth is no longer taxed as ordinary income. When you eventually sell, that growth is generally taxed as long-term capital gains rates, assuming you met the holding requirements. That single decision can be the difference between a manageable tax outcome and a life-altering tax bill. But there's one rule that absolutely cannot be ignored. You must file the 83B election within 30 days of receiving the stock. Not 30 business days, not by April 15th, not when you remember, 30 calendar days. If you miss that window, there's no extension. There's no appeal, there's no workaround. The IRS does not care that you didn't know about it. They do not care that your employer didn't tell you. The opportunity is gone. That deadline alone is why so many people miss out on the benefits of an 83B election. Even if you file on time, though, an 83B election is not automatically a good idea. In some cases, it can make things worse. One risk is that the company fails. If the startup goes under and the equity becomes worthless, you paid tax upfront on something that never paid you back. You don't get that tax refunded back just because the equity didn't work out. Another risk is leaving the company early. If you leave before your shares vest, you generally forfeit the unvested shares, but the tax you paid under the 83B election is not refunded. You paid tax on shares you never got to keep. Another risk is valuation. If the fair market value of the shares is already high at the time you receive them, filing an 83B election could mean paying a significant amount of tax upfront. That increases your downside if things don't go as planned. Cash flow matters too. Even if the tax bill seems small on paper, you still need cash to pay it. And when incentive stock options and the alternative minimum tax are involved, the numbers can move quickly. This is why the decision should never be automatic. In general, an 83B election tends to make the most sense when the current value of the shares is very low. You strongly believe in the company's upside, you expect to stay long enough for the shares to vest, and you can afford the upfront tax without putting yourself in a risky financial position. It tends to make less sense when the valuation is already high, your future with the company is uncertain, or you're stretching yourself financially just to pay the tax. And this is where a lot of people get tripped up because equity compensation doesn't exist in a vacuum. They interact with alternative minimum tax, capital gains planning, future liquidity events, and your broader financial picture. A decision that looks great in isolation can create problems later if it's not thought through carefully. If you have stock options, restricted stock, or any form of startup equity and want to avoid costly, irreversible mistakes, I wrote a free book specifically for you. It's called Take Charge of Your Equity Comp. This book walks through how equity compensation actually works, the most common tax traps people fall into, and how to think strategically about decisions like early exercise and 83B elections before it's too late. It's designed to help you understand your equity with confidence instead of guessing and hoping things work out. You can get a free copy of Take Charge of Your Equity Comp using the link below. Now there's one last misconception I want to clear up because this is where people get blindsided years later. Filing an 83B election does not mean you'll never owe taxes again. It doesn't make taxes disappear. It simply changes when and how you're taxed. You still need to think about long-term capital gains, alternative minimum tax exposure, and what happens when a liquidity event actually occurs. The decision you make early on can dramatically change the outcome when you finally sell or go public. That's why the 83B election isn't just a form, it's your strategic tax decision. Used correctly, it can save you a massive amount of money and give you far more control over your financial future. Used incorrectly, it can create pain you never saw coming. If this video helped clarify how the 83B election works and whether it might apply to you, make sure to like and subscribe. Thanks for watching, and I'll see you on the next video.